A standard professional trading screen is saturated with indicators. Operators rely on a dense layout of moving averages, momentum oscillators, and the relative strength index. The relative strength index, or RSI, is an indicator that measures the speed and magnitude of recent price changes to evaluate overbought or oversold conditions. Traders look across these various tools, searching for confluence. This animated diagram shows the mathematical formulas for MACD, RSI, and moving averages stacked on screen. They all share a mathematical vulnerability, indicator collinearity. MACD stands for Moving Average Convergence Divergence, a tool used to identify changes in the strength or direction of a trend. Despite the different mathematical operations applied by these tools, they all collapse back into a single identical input data stream, price. Because these indicators are derived from the exact same time series, they will inevitably produce highly correlated outputs. When the market trend is obvious, the shared derivation guarantees that all of your indicators will agree. During market noise, that mathematical overlap causes them to fail simultaneously. Because they process the exact same chaotic price inputs, they provide contradictory and erratic outputs, precisely when an operator requires clear guidance, creating a dangerous false sense of confirmation. Stacking price-derived indicators does not provide true confluence. It creates a closed-loop echo chamber. The operator is left blind to structural regime changes because the dashboard is constrained by a single isolated data feed. The phase-lock detector approaches the market from an entirely different mathematical angle. We abandon the isolated price action of a single asset and instead measure the relational behavior among a diverse basket of multiple assets. This diagram illustrates the architectural model of a complete graph. We see 10 disparate nodes pulled together via interconnecting lines, snapping into a symmetrical K10 structure. Each vertex represents a distinct financial instrument, while the edges represent their directional agreement. To analyze this structure, we apply Ramsey Theory. Ramsey Theory is a branch of combinatorics that studies the conditions under which order must emerge from apparent chaos. It allows us to detect exactly when the patterns within this graph become more organized than random chance dictates. By measuring coordination across the entire graph simultaneously, we identify an emerging phase lock. This is a structural coordination signal, marking an objective shift in market architecture, rather than a simple variation in price momentum. This diagram shows two isolated nodes, each driven by a motif vector. A motif vector is a simple 5-bar sequence of directional closes, recorded as a +1 for an upward close and a -1 for a downward close. We evaluate the relationship between any two nodes by comparing these sequences. If the two motifs agree at or above 0.6, the edge connecting them is colored blue to indicate they are aligned. If the motifs are inversely correlated at -0.6 or lower, the edge is colored orange, classifying it as anti-aligned. Scores between these limits color the edge gray, meaning the relationship is neutral. This architecture faces an immediate problem. Financial instruments that are inherently negatively correlated, like hedges or inverse pairs, will constantly generate noisy neutral or anti-aligned edges. Left unadjusted, this natural opposition destroys the mathematical coherence of the graph. This diagram demonstrates the system's mathematical solution, inverted mode. For negatively correlated assets, the system rapidly flips its signs before the edge is calculated. By transforming +1s into -1s, it dynamically converts a neutral edge into a blue aligned edge. This ensures their structural contribution is preserved. Opposing motion becomes mathematically aligned in the inverted space. This process ensures the system measures pure directional coordination across the network, entirely untethered from any individual asset's raw market beta. This diagram highlights the full graph to identify a monochromatic clique. A clique is a subset of vertices where every pair is connected by an edge of the same color, manifesting here as K3 and K5 structures. Theorem R of 333 equals 17.
That theorem anchors our logic. In any complete graph with 17 or more nodes colored with 3 options, the formation of specific monochromatic structures is a mathematical inevitability. On a live trading screen, we typically run 7 to 10 agents, remaining well below that threshold of 17. Because a clique is no longer guaranteed, we must test if the observed structures are statistically significant. This split-screen visualization illustrates the permutation engine. On the right, the engine shuffles motif data bars vertically at high speed, recalculating edges and dropping triangle counts onto a growing bell curve to test significance. Standard analytical formulas fail to calculate this accurately because edge states are dependent. A single node's motif vector dictates its relationship with every other node. The observed graph's clique count is plotted against this permuted bell curve to generate a z-score. Only when the count produces a z-score exceeding 2.5 against the null will the system declare a true phase lock. The permutation null is an uncompromising mathematical filter. It guarantees a signal is triggered only by market coordination that is statistically impossible under random conditions. In live markets, raw z-scores are volatile. We process them through a sliding 10-tick hysteresis window. This stabilizes volatile data spikes into a clean, actionable regime block, preventing the operator from being whipsawed. The regime manager utilizes asymmetric logic. It requires 6 locked ticks out of 10 to turn the regime on, but the lock count must drop to 4 out of 10 to turn the regime off. This architecture maps the version 9 design, the independent dual-engine architecture. We separate the data into real-time and projected pipelines that eventually converge at a single fusion gate. The real-time pipeline processes actual market behavior of the immediate past. The projected pipeline ingests AI-generated future bar estimates. Both pipelines execute the exact same Ramsey tests, independent of one another. By forcing the backward-looking history and forward-looking projections to independently detect the same structural phase lock, the probability of a systemic false positive drops near zero. The fusion gate sits at the end of the architecture. It synthesizes the separate outputs of the dual pipelines into a single binary operational verdict. This interface crop shows the conflict state. Here, the projected box indicates a buy structure, while the real-time box indicates a sell structure. The operational rule for a conflict is absolute. It is a strict no-trade zone. The forward and backward structures are telling contradictory stories, and the operator must wait for resolution. If only one pipeline detects a structure, the system enters a divergent state. This serves as an early warning of organization, rather than an execution signal. This UI element reveals the ultimate execution state, full phase lock. The banner pulses gold, displaying the trophy icon and a dual buy confirmation. This visual confirms both pipelines are currently operating in a verified phase regime and are fully aligned on direction. This represents the system's highest conviction trading environment. The fusion gate ensures operators do not have to perform real-time discrete mathematics. They execute against the strictly gated outputs of the dual-engine architecture. To utilize this signal effectively, an operator must recognize the difference between market direction and structure direction. Market direction is what raw prices are doing right now. Structure direction is the mathematical consensus of the mode-inverted graph. This specific UI crop isolates the structure up and down bar. It highlights a prominent lightning bolt divergence icon, a critical warning label on the dashboard. The divergence icon indicates that the phase lock's structural coalition is actively fighting the current raw price tape. The mathematical organization is pointing one way, while the immediate price action points the other. When true mathematical structure diverges from raw price, the structural alignment frequently acts as the leading indicator for an impending reversal. The phase-lock detector does not predict price. It applies rigorous graph theory to identify the exact moments when a market ceases to be a random walk. By isolating mathematically verified coordination, it provides operators with the structural wins required for high-probability execution.